At its core, private equity is defined as the provision of medium to long-term finance to potentially high-growth companies. These companies are entirely unlisted. They operate completely outside of the public stock exchanges. In exchange for providing capital, the investor receives a direct equity stake in the business. That stake means the investor is now directly exposed to the operational reality of the company. The final return depends on the growth and profitability of that specific business. If the unlisted company fails, the private equity investor absorbs that failure right alongside the founders. Their capital is wiped out. This is the core trade-off of the asset class. The investor accepts the total risk of business failure in exchange for pure exposure to the absolute upside of business growth. A public market investor can sell their shares on an exchange on any given trading day. A private equity investor cannot. This creates the defining structural hurdle of investing in unlisted companies: poor liquidity. Because the company is unlisted, there is no immediate secondary market to sell that equity stake if the investor suddenly needs cash. To understand how this asset class functions, we have to map exactly how large institutional investors navigate this extreme illiquidity to eventually extract massive returns. In private equity, time is a locked commitment required to build value. To see why a company chooses private equity, we have to look at the mechanical alternative, traditional corporate borrowing. When a traditional lender provides debt capital, they require fixed, regular interest payments, regardless of whether the company is highly profitable or struggling. This makes debt a lower risk mechanism for the lender. They possess a strict legal guarantee of repayment. Private equity operates without any legal guarantee of repayment. The capital is injected directly into the business. The private equity firm receives zero immediate yield. There are no steady interest payments to offset their initial risk. Instead, the firm's reward is strictly tied to the company's long-term operational success. The return only materializes as a massive capital gain at the very end of the investment lifecycle. Traditional lenders charge a fee for the use of their capital. Private equity firms partner with the company to engineer exponential growth. If the ultimate growth spike is so large, why don't large investing institutions just buy unlisted companies directly? The mathematical answer is concentration risk. Placing hundreds of millions of dollars into a single high-risk buyout means that one operational failure would be catastrophic for the institution's capital. The financial sector solves this through the pooled investment vehicle. Multiple institutions combine fractions of their capital into a single massive central fund. These institutions entrust their money to the private equity firm because of the firm's specific expertise in sourcing, vetting, and managing high-potential businesses. The pooled vehicle then disperses that capital across multiple unlisted companies, creating a diversified portfolio of investments. Pooling capital dilutes the risk of any single company failing, while maintaining the institution's total exposure to the high returns of the asset class. Once the capital is deployed, the portfolio enters a holding period, typically spanning several years. The private equity firm does not wait passively. They actively work to increase the intrinsic value of the business over time. The final returns depend entirely on the business becoming significantly larger and more profitable than when it was first acquired. Throughout this entire growth phase, the invested capital remains highly illiquid. All of this operational engineering is purely theoretical until the private equity firm can execute a liquidity event. This terminal liquidity event is called the exit. It is the specific action where the firm realizes its capital gain through one of four distinct routes. The first is a management buyback, where the company's own internal management purchases the shares back from the private equity firm. The second route is a secondary sale, which involves selling the equity stake to another private equity investor. The third option is a trade sale, where the shares are sold to a strategic corporate competitor or a larger firm within the same industry. The fourth and most public execution is achieving a stock market listing, or an IPO. An IPO converts the private, unlisted shares into highly liquid public shares that can be traded on an open exchange. Without successfully executing one of these four specific strategies, the paper returns of a private equity investment remain permanently trapped. We can now trace the full journey of the capital. It begins with the institutional pooling of resources, moves through the illiquid holding period to build diversified value, splits into the targeted exit paths, and emerges on the other side as a larger block of capital gain. It is only upon the successful execution of an exit that the growth in value is actually captured. Those liquid gains are then distributed back through the vehicle to the pension funds and institutional investors who supplied the initial capital. This complete life cycle proves how structured patience is mechanically converted into premium returns. The profile of private equity is defined by what it deliberately trades away: short-term liquidity. It accepts a high structural risk of business failure in exchange for pure exposure to aggressive corporate growth. This level of risk is only mathematically viable for large investors through the use of professionally managed pool diversification. Mastering this asset class requires understanding a simple mechanical truth. Value in private markets is not tracked daily. It is built over years, and it is harvested at the exit.